Welcome to our in-depth analysis of the October 10th U.S. market decline and its significant impact on the financial landscape. The single biggest catalyst that shattered months of calm and sent markets tumbling was a sudden, aggressive threat from President Donald Trump regarding China. Trump took to his social media platform, threatening a massive increase of tariffs on Chinese imports and suggesting he might cancel an upcoming meeting with President Xi Jinping. Fear of a full-blown trade war 2.0 instantly hit the market as global trade friction hurts corporate profit margins and supply chains. Investor sentiment flipped from bullish to extremely fearful, leading to widespread selling. The tech-heavy Nasdaq composite suffered the steepest loss, sinking about 3.6%. Companies like Nvidia, Apple, and AMD, which rely heavily on global supply chains and trade stability, were in the crosshairs, leading the sell-off. The market was already primed for a slide before the news broke due to underlying valuation concerns. The S&P 500 had been on an almost relentless run, up significantly since its April low. Critics pointed out that prices, especially in the AI and tech sectors, had outpaced actual corporate profit growth, leading to very high valuations. The tariff threat provided the perfect excuse for institutional investors to take profits off the table, especially in stocks that had run up the most. Beyond trade tensions, other headwinds contributed to the market's vulnerability. The ongoing U.S. government shutdown contributed to uncertainty by delaying the release of key economic data. A report showed that U.S. consumer sentiment remained in the doldrums, concerned about high prices and a weakening job outlook. This suggested soft economic fundamentals, adding another layer of concern for investors. Looking ahead, elevated volatility is expected to remain early next week. The sharp sell-off on Friday will likely lead to follow-through selling or at least nervous trading on Monday. The market's direction will be highly dependent on geopolitics, such as any clarification on Trump's tariff threat and the start of the corporate earnings season. Based purely on technical analysis, we need to watch where the market finds reliable footing. Look for a bounce around the 6,500 level for the S&P 500. This is a major psychological and technical round number. If selling pressures continue, the next significant line in the sand is likely the 6,050 to 6,200 area. This zone likely corresponds to the midterm 50-day moving average or a key Fibonacci retracement level where long-term buyers may step in. While a massive crash is still a low-probability event, the market won't stop falling until the uncertainty over the trade war is resolved. Alternatively, prices must become cheap enough to entice the big money buyers back in. For investors, our recommended strategy is to stay rational, not emotional, and avoid panic. Revisit your thesis. If you own high-quality companies with solid balance sheets, stick to your long-term investment plan. Don't let a single day drop force you to turn paper losses into real ones. Cash is king for now. If you have a cash reserve, this decline offers more attractive entry points for investments you've been eyeing. Consider disciplined buying through dollar-cost averaging. If you choose to buy the dip, do so gradually. Don't deploy all your capital at once. Use a dollar-cost averaging strategy to smooth out your entry price and focus on quality. In uncertain times, capital often rotates toward high-quality, market-leading companies, also known as blue chips. These companies typically have strong pricing power and stable cash flows. Finally, diversify and de-risk your portfolio. Ensure you are not overexposed to the hardest-hit sectors, especially speculative, high-multiple tech names. Look for defensive plays by adding exposure to sectors more resilient during economic slowdowns and volatility, such as utilities or consumer staples. The market will always be volatile, folks. Stay calm, stay smart, and remember that downturns are a necessary, healthy part of the investment cycle. Good luck next week.